So what's in this big giant stimulus package for me or for you? We'll talk about all of that on the program, along with, of course, a recap of the past week that was in the markets. Once again, another week of the market volatility being at an all-time high, although for this past week, we saw that the volatility was actually on the plus side of things. So we'll certainly have much to cover on the program as we do each and every week. This is Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and we are doing this once again in a different format in this day and age with the virus mitigations that we're all doing and the way that society is. We're actually, once again, not in the studio. I am recording this program actually from the office, and the producer is over at the radio station. And for right now, we're not able to go into the studio during the course of the weekend, so we are actually taping this program on Friday morning. So a lot of what we'll be talking about in the program, we're operating under the assumption that the House, in fact, will pass the legislation that is the virus program that is estimated to be $2 trillion of a legislative stimulus package. So with that assumption, we will certainly dig into some of the details in that legislation that have become known. It's hard to get a full version of the legislation read that quickly because it's a big piece of legislation and they are fast tracking it along very, very quickly. So, but we'll certainly attempt to dig into that here on the program today. So, some interesting things in the package itself. I mean, obviously you hear about the large portion that is being spent and set aside. I would caution you that the number sounds really big, and it is. And the point of that is that the attempt there is to try and make as much of a difference in the economy as possible by injecting a tremendous amount of funds into the economy. It's not all just handouts, by the way. I know it's getting described as a $2 trillion package, but the reality is that a lot of the portions of the $2 trillion amount are in fact loans. And loans have a tendency, or well, they should all have a tendency to get repaid. I think back to the TARP program that was the $700 billion program back in 2008 that was intended to shore up the balance sheets of banks and lending institutions back then. And what's interesting about that program, and this is the part that people sort of forget, is they only remember the $700 billion price tag. They forget that within a 3-year period of time, there was a payback of 100% of that money. So I think, when we hear the number 2 trillion, and obviously it's a big number, understand that the government isn't totally going on the hook for the 2 trillion because a lot of it is in the form of loans. Some of it, of course, is not, and that is certainly the case for the biggest piece that affects folks on an individual basis, and that is the checks that are going to get either mailed out or deposited, or maybe a debit card or something like that. They're still trying to figure out and explore how much of, or what's the form of delivery for those dollars, because just printing everybody a check takes a lot of time. And so they're really trying to figure out what that might look like. And I don't know that they've come to any firm conclusion on it, but I would be checking your bank account, check your mail, check your mail for a debit card. All of those are options that are certainly on the table. But the $1,200 is just that. It is a $1,200 sort of no strings attached type of payment that you'll get from the federal government. Very similar to what they did back in 2009 with the $600 payment, if you remember that. That was just a check that sort of showed up in the mail. That one went across the board to everybody. The reality is this one is got some income testing in it. So just to get that on the table with y'all, it's $1,200 a person, and then per child, it's $500 per child. If you are single and making under $75,000, then you're going to get the entire $1,200. If you're a couple, married couple making under $150,000, then again, you're going to get $2,400. As your income starts to go up, it starts to phase out. So above $100,000, that single person not eligible for this direct payment of the $1,200. For a married couple, income above $200,000, not eligible for any part of this payment. So the income numbers are based upon your 2018 tax return. It's not on your 19 tax return, because many people obviously are still in the process of filing the 2019 tax return, but the numbers are based upon the 18 tax return numbers. So just be aware of that. That is a payment that is coming direct to you. So you're not going to have to declare it as income. You're not going to have to repay it or anything like that. It is a direct check to you. So that's 300 billion, if you will, of the 2 trillion is accounted for in those direct checks. Another 250 billion of the 2 trillion is in unemployment. We saw this past week where unemployment claims jumped by like 3 million people. It was just an unbelievable record that was set this past week in terms of the jump in unemployment claims by over 3 million people over the prior week. The next biggest chunk of this stimulus package is the 250 billion that's been set aside for unemployment. What's interesting about the unemployment is generally the unemployment extends to people that work for employers. The provisions in this stimulus package also extend that to people that are self-employed. So let's say that you are an Uber driver or something like that. Obviously your business has diminished and gone to zero, and so consequently the unemployment benefits were expanded to pick up that type of job, which is very unique and not something that unemployment typically covers. So they expanded unemployment to sort of pick up folks that it would not typically pick up, and then they also extended the payment period. Typically unemployment lasts 26 weeks. They extended that to be for a period of 39 weeks. And most importantly, they added an extra $600 per week for that 39 week, for that, so that 4-month period of time. For the first 4 months until July 31, that is where you will be getting that extra $600. So between now and July 31, if you're collecting unemployment, it's going to be for a much higher amount. Typically unemployment only around like $300. That doesn't really cover it much. So the notion of adding the extra $600 is to get things closer to what the average person makes in a week, which is around that $1,000 number. So that was the point of trying to get it to that higher number. So those are the two biggies of the stimulus plan: the direct checks, number one, and then the expansion of the unemployment benefits. A lot more, though, that we need to kind of work through. So we will continue that, but we'll do so after the break. So stay tuned through the break, and we'll continue on the conversation of what's in that stimulus bill for you next here on the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Howdy friends, Dollars and Cents. This is Joel Garris of Nelson Financial Planning. On the program today, we're talking about that big stimulus package that, given that we had to tape the program on Friday, we're making the bold assumption that the folks in the House were able to get their act together and pass it. The reality is that given this coronavirus crisis, that we're not able to go into the studio on the weekend, and neither are the production team. So we're doing it on Friday in order to give you the latest and greatest content, and sort of operating on the assumption that the stimulus package of $2 trillion will get passed. We talked in the last segment about the two biggest parts that probably have the biggest implications for most folks, and that's the direct payment of the $1,200 per person. Remember, that is income based. If you make over 100 grand as a single person, 200 grand as a married couple, you're not going to see any of that. You have to be below 75,000 as a single person, below 150,000 as a married couple in order to get all of that. Also talked a little bit about the extension of unemployment benefits. For the first time, unemployment benefits are extended to those that are self-employed. So that's a new change, if you will, for unemployment. Also expanding the coverage from traditionally 26 weeks to 39 weeks, and also upping the amount from with an additional $600 per week for the next 4 months until July 31. After July 31, it reverts back to the normal unemployment amount. So be aware that that extra amount for unemployment only applies for the next few months until July 31st. So those are the two biggies that certainly you're hearing a lot about. And then there's other parts, right? Because the unemployment benefit portion was only $250 billion, and the direct checks to Americans was only $300 billion. So where's the other, $1.5 trillion coming in? Well, here's where the rest of it comes in. And this is where it comes more into the form of loans. So that those first two parts, remember, those are parts that are not going to have to be, well, in the example of the direct check, that's not going to have to be reported as income, and you're not going to have to repay that. Similarly, you would not have to repay your unemployment benefits, but understand that traditionally unemployment benefits are in fact taxable as income. So a little bit of a distinction there. Those payments are obviously payments that are going to be made out from the federal government. The next chunk deals with the portion of the stimulus package that is in the form of loans. And remember, a loan means that it gets paid back. If history is our guide, there's a high likelihood that all of these loans, or at least the vast majority of them, will get paid back. And in fact, the US government will probably make a little bit of a profit on this stuff. They did that back in 2008 with the Troubled Asset Relief Program. That was a $700 billion program that went predominantly to banks. All of that money within a 3-year period of time was repaid with interest. So hopefully we'll see those same things play out on this next chunk, which is the roughly $850 billion of the $2 trillion is in the forms of loans. So it's small business loans. That accounts for another $350 billion. When you stop and think about it, these are really, really big numbers. $350 billion, but the damage to the economy has been really, really big. So when you shut things down and you cause revenue to go to zero, you don't all of a sudden make your rent payment and your light bill disappear as well. You still have to pay those. And if you want to try and keep your employees, you still have to pay payroll. So the notion of this being a large amount is understandable given the dynamics. But $350 billion in the form of small business loans that are going to be administered by the SBA. There are actually parts of those loans that you wouldn't have to repay if they're spent on payroll or rent or utilities. There's a lot of details that are emerging on all of this legislation in terms of the streamline and the process. It's expected that it's going to be a much more streamlined and direct process to get these loans from as a small business. Next level up, there's another $500 billion for corporate loans, and those are loans to large companies, think airline industry. And what's interesting here is, again, much like in 2008, there is the option of direct equity stakes that the government is going to take in that business. So if you're a large corporation, you're in need of cash, you can get it in the form of a loan, but understand, number one, the loan's got to get repaid, and number two, you may have the U.S. government as a silent, well, I'm not sure the U.S. government's going to be all that silent, but as a shareholder in your company. So be aware that that's that part of the virus stimulus package. Next is some business tax benefits, about $220 billion there, where you're allowed to defer payroll taxes, where you can use today's losses against past profits to potentially claim a refund for cash quickly. And then there's also some grants to the airlines. That's $25 billion. A lot of money going also to hospitals and medical clinics and things like that as well. On back to more specific things that would affect you on an individual basis. So last few things on the list here. Number one, the stimulus package doubles the amount of money that you could borrow from your 401k. Typically the limit is $50,000. They've increased that to $100,000. Again, I'd be very reluctant to borrow from your 401k because you're basically rating your retirement. But understand that difficult times require difficult decisions. Know that you can borrow twice as much as what you could have from your 401k. But again, you really want to almost treat that as an option of last resort. Another option of last resort that they're allowing you to do is they're allowing you to take up to $100,000 out of your retirement without the 10% penalty that would typically apply. So again, it's got some options here. It's not going to be as painful if you have to go that route, but you don't necessarily want to be going that route anyway because you are, in fact, rating your retirement, if you will. So those are some of the new features that are available out there that allow you to borrow more from your 401k or allow you to avoid what would be a early distribution penalty from your retirement if you took money out. Also, more importantly, for the year 2020, they have suspended your required minimum distribution. Let me say that one again. For the year 2020, much like they did in 2009, they have suspended your required minimum distribution. I think that's a great feature of the stimulus package because what that means is that as an investor, you don't have to take money out of your retirement account. You're not forced into doing that, and then that allows you to kind of keep the money there. It remains invested so that it can continue to sort of go through the recovery process that will follow, as it always does whenever the markets go through a tough time. So for 2020, suspended required minimum distributions. Also, if you have a student loan, you can suspend your payments through September 30th without interest, but that's not automatic. You've got to elect that feature. And then lastly, in terms of kind of the highlights that we wanted to throw out on the program today, if you don't itemize, even if you don't itemize, you're going to be allowed to claim up to $300 for a potential charitable contribution. So know that you've got some options. If you make charitable contributions where typically, because of the higher standard deduction, you're not able to get a benefit for that, this legislation has the ability to take at least 300 of those and write those off against other income, regardless of whether you itemize or not. So a bunch of stuff. As we said, we're having to do this program on Friday. The expectation is the House is going to pass it very much intact with what the Senate version is. Obviously, stay tuned on the program if that changes. So we will take a break. When we get back, we want to kind of recap and expand on a couple of topics from last week's program. So we'll do that when we return here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. In this segment of the program, we're going to recap on some of the concepts that we put out last week in terms of things that can investors can do now in light of what's going on in the markets and in light of what's going on just generally in the economy. And we want to just expand specifically on three topics that we covered last week that we sort of ran out of time in the program. So first and foremost, as you perhaps know, the tax filing deadline has been extended until July 15th. What that means is that you don't have to file your taxes until July 15th. You don't have to make a payment until July 15th. And you also could, in fact, fund your IRAs and things like that as late as July 15th. But hold on. You really want to do that as soon as possible. Do not take the extension of that deadline as an opportunity to just set your tax stuff aside. The reality is, for a lot of people, you're just kind of sitting at home. So you might as well get your tax stuff done. And certainly the ability to deliver that to a tax preparer would be within the realm of being a financial transaction that certainly you're allowed to travel for, no matter where you're at. But here's the concept, okay? Look, if you get your taxes done and you're getting a refund, why wouldn't you want that money right away? I mean, particularly in today's climate with people losing their jobs and things like that. Why? I mean, you'd want that refund right away. Well, the only way you know whether you got a refund or not is if someone takes your information, throws it into a software program and comes up with it. So that's number one. And here's the thing, if you owe, then you're still going to want to know that, right? Because that at least gives you the next 3 months to be able to plan and prepare for that. And you still can get your taxes filed and have the payment be deducted out of your checking account on July 15th. The software programs that we use, for example, at the office, they're all getting updated constantly with all of these changes. And one of the updates, of course, that happened this past week was allowing us to adjust the withdrawal date of that payment out of your checking account to July 15th. So you can still get your taxes filed and set it up so that the payment comes out in July. And you want to do that because it gives you the opportunity to take the next 3 months and make sure that you've got the money to be able to cover it. Or if you're taking it out of your investments, give your investments the opportunity to continue kind of the recovery that we saw this past week. And lastly, when things get tough economically, there is more criminal activity. Particularly, one of the most susceptible places for criminal activity, or one of the most popular places of criminal activity this time of year, is tax filing fraud. And what that means is somebody somehow gets a hold of your Social Security, your date of birth, whatever the case may be, they throw a tax return in, and then they collect a big chunk of money. And then when you try and file your taxes, the other one was already in there first in line. And so now you've got a problem of having to talk to the IRS and go through this process of, okay, wait, that wasn't me that filed that fraudulent tax return. So the reason that you want to get your taxes done is the obvious ones. If you're getting a refund, get the refund. If you know you owe, at least you know the number. And then lastly, more importantly, hey, don't put yourself at risk for criminal activity, right? The longer you sit around and don't file your taxes, the more likelihood is that somebody could snake in there in front of you criminally, use your information, and file a fraudulent tax return. So again, there's some very valid reasons to getting your taxes done. Try to hold to that April 15th date as much as you can and get your taxes filed. Again, you can still set it up so either the payment is automatically debited on July 15th, or if you decide to send them a check with a little voucher payment, then that's great. Just make sure you get that in the mail by July 15th. So wanted to just take a few minutes and expand on that notion of taxes and making sure that you stay on track for that. Next, I think this is really an opportunity to take a look at how you spend money. We talked about a little bit about this on the program last week, is use this as an opportunity to perhaps look at what your cash flow currently is. And if you are, for example, retired, look at it as an opportunity to say, okay, maybe I don't need as much money right now, so I'm going to reduce down what I'm taking out of my investment accounts so that give them an opportunity to recover. Maybe I don't need my required minimum distribution right now. You've got the ability to suspend that for the year 2020 thanks to the stimulus package. And so that gives you an opportunity to see exactly what you're spending money on. I think far too often, one of the biggest issues that people have, whether they're retired or whether they're working, is you sort of lose track of how much money you spend. And this is particularly true if you're working and you're younger. It's so easy to kind of let life fly on by, spend money on whatever, and then at the end of the day, you sort of always every month run out of extra money. So then you put off saving, for retirement, you put off building up an emergency savings account. Use this as an opportunity to say, okay, the fact that all these places are closed, maybe I could take some of that money that I had been spending, because you should be seeing that building up, and take that as an opportunity to, maybe I'll fund my retirement a little bit more. Maybe I'll try and put some more into my emergency savings. So I want to encourage folks to use this as an opportunity to kind of really look at their income, really look at their budget, and see, maybe I don't need to go to Starbucks every day. Even when things return back to normal, maybe I don't have to do that because, hey, I can, I just made coffee at home rather than go to Starbucks. And so consequently, maybe that's an opportunity to really look at how you spend money and hopefully change behavior so that when things do return to normal, that you're able to actually save some money, put it towards retirement, build an emergency savings account, those kinds of things. So really try and think about this as a little bit of an opportunity to really dig a little bit deeper in your financial spending habits and how you could improve them. That certainly applies to folks that are working. If you're retired, again, look at it as an opportunity to say, okay, maybe I don't need to take as much out of my investment account right now. I'll leave more in there and let that continue to recoup. And then lastly, a concept that we mentioned last week was this notion of taking advantage of some capital losses. Now that's an option that's only available outside of a retirement account. If it's inside of a retirement account, that doesn't really matter. All those dollars that are coming out are going to be ordinary income no matter what. This applies to investments that you would have outside of an IRA or 401k, basically sort of a regular investment account. With a regular investment account, you may be looking at the numbers and saying, well, wait a minute, now on paper, I have a loss, right? Maybe I invested $10,000 in January and lo and behold, now it's $8,000. Well, you've got the ability, if you're using mutual funds, to be able to exchange that. And I'm not saying exchange that to cash. Let me be very, very clear, because then that would mean that you would be getting out of the market. We don't want you getting out of the market in any way, shape, or form. But what you can do is you can take that and move it over to a similar fund. If it's a large cap fund that you purchased, move it over to a large cap fund of similar nature. Most mutual fund companies have a multitude of those types of funds, which gives you the flexibility to move around. The reason I say stay with the same mutual fund company is if you start crossing mutual fund companies, then you're going to start to have some transaction costs in there. So the point of this exercise is to try and capture that paper loss, convert it to a tax loss, a realized loss. And in order to do that, you've got to actually sell the position, but don't get out of the market. Slide over to something within that same mutual fund company that's similar in nature so that as the market recovers, you can continue to experience that even though you sold the position that you had that had the loss. What that means is, and what that allows you to do, it allows you to then take that loss on your taxes to save you money on your taxes. We'll kind of recover that one a little bit more because we're running into a break. We're going to take a break. When we come back, we'll kind of flesh that one just a little bit longer so that you understand exactly the process that we want you to follow for that. And we'll do that when we get back. This is Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio, WFLA. This is Joel Garris of Nelson Financial Planning. Dollars and Cents, one of the top 25 financial planning podcasts on the World Wide Web, recently given that honor by the folks at FeedSpot at the beginning of the year. And certainly we continue to broadcast on a variety of platforms, not just the radio program here, but also on various podcast channels, whether that's Google Play, iTunes, whatever the case may be. And we are also, of course, doing video now as well. That's over on YouTube, along with some options for videos on Facebook as well. So make sure you check us out. Simply look us up, Nelson Financial Planning. That's our channel on YouTube, along with, of course, our Facebook page, and we encourage you to do that. If you have trouble finding us, you can always go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of different icons. Click on the one that looks most familiar to you, and you will be automatically redirected over to our particular channel. So make sure you check us out on that. And certainly a variety of options available for you. So before the break, we were talking a little bit about this notion of how to take advantage of capital loss opportunities in an investment portfolio. And the key concept is that this part of the conversation applies to investments that you have outside of a retirement account. Inside of a retirement account, it's immaterial. Outside of a retirement account is where you could take those paper losses and convert them to a tax loss that you can then use on your tax return. But a couple of things to observe if you're going to do that. Number one, this is not an exercise where you get out of the market. If you've been in the market and you need to be a consistent investor, this is not I'm going to hop out of the market for a little bit. This is simply an opportunity to take on paper what is a loss and convert it to a realized loss, because it's only those types of realized losses that you can in fact have on your tax return. So let's say you put money into an account, $10,000 at the beginning of the year. It's now worth $8,000 and you've got a $2,000 loss. If you exchange that fund to a similar fund, you basically maintain the same investment allocation, but you're able to then take that paper loss, convert it over to a realized tax loss, and now you've got something that you can put on your tax return that will help to reduce down your taxes for this year. And if you don't use up all of it, guess what? Carries over to next year. You can use up to $3,000 of a capital loss against income, and whatever the excess is, then you can certainly carry it over to next year. To minimize transaction costs, you want to stay generally within the same mutual fund family. You don't necessarily want to be jumping around mutual fund families, because then that generates additional cost for you. The parameter you have to observe is if you want to go back into the fund that you previously owned, you've got to be out of that fund for 30 days. Otherwise, it is a wash sale. That's the other little tweak to this thing is if you do decide that you want to go back and own the same fund that you used to own, the reality is, though, that you have to wait the 30 days in order to get back in. Otherwise, that loss that you generated is going to be deemed a wash sale, and you're not going to be able to use that on your taxes after all. So just be aware of the parameters on that. Now, shifting gears a little bit. So those are the concepts that we talked a lot on the program last week. We wanted to expand on it. Make sure you get your taxes done, and so you know what you got. Make sure you use this as an opportunity to kind of really look at your cash flow and look for ways to save. And then, of course, lastly, the notion of generating some capital loss inside of an investment portfolio to help save you on your taxes going forward. We would be remiss if we didn't recap the market, right? I mean, especially as volatile and as headline driven as the market has been. Certainly this past week is where you saw sort of the other side of volatility. We talk a lot about the market having volatility, but anytime we do that, people always think, well, wait a minute, that just must mean the market's going down. And the reality is that volatility has two different components. It has an up component and a down component. Unfortunately, the media emphasizes the down and not the up, but understand that weeks like we just saw are very much a part of the volatility that comes when you have a major economic event. And to just give you one statistic to kind of be aware of, if we look back to 2008, if you look at the 20 best performing days in the market over the past 75 years, you will actually find 7 of those 20 best days actually occurred in the year 2008. Again, that underscores our point, which is that volatility has two sides, both down and up. And that's what makes trying to time the market, trying to get in, and then I'm going to get back out, I'm going to get out, and then I'm going to get back in when things are, you're never going to be able to do it. The decision to get out of the market is the easy decision. The much harder decision is knowing when to get back in, because basic human emotion is not going to have you get back in, okay, when things are worse, right? Because if the headlines were so bad that you got out of the market and then they get worse from there, how is that going to make you more comfortable enough to put your investments back into the market? It won't ever happen. The reality is it's far better to stay consistent. It's far better to try and avoid this notion of getting out, because while that is a very easy decision, that forces you into a much harder decision, which is when to get back in. Because the reality is you're going to feel better. You're going to feel that this crisis is behind us. And guess what? The market will already also feel that way and be well in front of you. So be very, very careful about trying to hop in and out of the market. This week, a perfect example of that. If you had said to me on Monday evening, Joel, the market over the next 3 days is going to go up nearly 20%, I would have said, absolutely not. If you had told me that Tuesday was going to be the single best day in the market since 1933, I would have said, probably not. Okay, but the reality is that's the difficulty of predicting the future, and one of the biggest reasons why you want to stay consistent on your investments. Now, let me be very clear. We still are in a very volatile period of time. I still think that there's going to be more volatility ahead. This crisis did not all of a sudden pass this past week, and it certainly did not all of a sudden get warm and fuzzy just because the folks in Washington threw $2 trillion at it. There's still a lot more news to come. There's still the actuality of the economic impact of what this virus is having across the country. So make no mistake about it. I'm not saying the worst is behind us, only the best is in front of us, but I do think that the market has certainly priced in a pretty rough case scenario, and certainly what we saw this past week is sort of that normal part of volatility. So continue to remain vigilant on your investments, continue to remain consistent. I think this week really helps to encourage folks to continue to remain in consistent on their investment approach, because it really does give you immediate example and proof of the notion that volatility has both sides of the equation, both down and up, and far better to be consistent on it than trying to sort of pick your spots, because you will ultimately face a much more difficult decision, which is when to get back in. The decision to get out is easy. It really is. The decision to get back in is a much harder one, and one where the real damage to your portfolio comes into play. So some thoughts on all of that. We will wrap it up and get on out of here, and of course be back next week and continue the conversation. We'll probably have some more details on what's buried inside that $2 trillion package, and so be sure to stay tuned for that. Thank you all for listening in to the program. We will get on out of here. You've been listening to Dollars and Cents with your host Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando.